Good afternoon, everyone. Thank you for coming in on such short notice. So, as you know, there is a big client coming in next week, and they wanted to discuss partnerships. So I figured I'd assemble everyone from all over the country, and given that we don't see each other that often, we'll go around the table and introduce ourselves. I'll start. My name is Cynthia, and I am the managing partner at Gold Tax Advisory Services.
Hi, I'm Priya, and I'm the tax partner from Quebec.
Hi, I'm Elena, and I'm tax partner from Ontario.
Hi, my name is Joanne. I'm the tax partner from the West.
And I'm Arizu, tax partner from East.
Great, so I'm going to kick it off and give a quick overview of partnerships. That is what the client was interested in knowing. So essentially, I've divided it up into three different parts: definition, element, and types. And as we all know, definition itself isn't a tangible one, so there isn't a properly laid out definition, but there is a folio to which we can refer for guidance. Also, we can look at partnerships from the perspective of provincial law and case law or precedent, where applicable. Now, there are three elements that we need to consider when talking about partnerships. The first one being that more than two persons who are taxable entities are required. These two people need to be carrying on a common business, and the purpose of them carrying on the common business should be to generate a profit, which logically makes sense. And there are three different types generally of partnerships. So we have general partner, limited partnerships, and limited liability partnerships. And you know what, I'll take it to Elena to kick it off.
Yes, I'll go you through for the partnership income and income allocation. So, for tax purposes, a partnership is viewed as a person resident in Canada. Depending on the type of its partners, being individual or corporation, so it will have different fiscal year end. So for individuals, usually it will have December 31st year end. For corporation, they can choose year end ending within 52 weeks from the beginning of the fiscal year. So similar to corporation, partnership business income is calculated on accrual basis, meaning that we'll have to make the same adjustment as for the corporation, and the income is also allocated on accrual basis, meaning that the partners will recognize the income when it is allocated, not when it is physically received. Main types of income that are flowed through partnership are dividend, capital gains, property income, business income, and not limited to that. So, as I said, business income is calculated in the same manner as for the corporation. So we will start with the accounting income and making the appropriate adjustments. The main adjustments that are different from the corporation are that salaries to partners are not expensed, so they have to add it back to the accounting income, and they will be treated as withdrawals from the partnership. Just to make sure, once again, partnership are not taxable entities. The income is taxed in hands of the partners. So political contribution, charitable donation, partners, personal expenses, these are not expenses to the partnership. They are allocated to the partners. One more thing about the dividend income is that the dividend income is allocated in full amount to partners, meaning if it is an individual, the individual will have to gross it up and claim the dividend tax credit. If it is a corporation, it will have to treat accordingly, meaning to subtract to get to taxable income. The income is allocated to partners depending on their agreement. So being that proportional, being that prorated, it depends what is stipulated in the agreement. It has to be reasonable, just because the Canadian Revenue Agency will treat that method which is considered reasonable. So I'll let my colleague to continue.
Okay, so what I'm going to first do is define what a partnership interest is. So it's a right to the profit and losses of the company, and as well as to the company's property. It is considered a non-depreciable property, so such a disposition will result in a capital loss or a capital gain. So when is a partnership acquired? It is acquired by forming a new partnership, from taking it from an existing partner, or directly from the partnership by transferring assets to the structure. So what is the difference between a new partnership versus an existing partnership? So the ACB of an existing new partnership would be the fair market value of all the assets you put into the partnership. The existing partnership, the ACB, would be the purchase price you paid for the partnership interest. So what are the most common adjustments to the adjusted cost base we make are the income allocations, the current year drawings, and the capital contributions. So what is the difference between all of them are that when capital contributions are added to the added when they occur and withdrawals are deducted when they occur. So the rest of the adjustments are done at the following fiscal year end. So let's define what a limited partner is. So limited partner is liable only to the partnership according to the partnership law. So limited partnership generally has one limited partner and one general partner. So a limited liability partnership is not liable personally for all debt. That's why it's different from the other partnerships. Now the at-risk rules were introduced because there were very high-risk ventures that these partnerships would go into. So, for example, mining, explorations, and films. Therefore, these at-risk rules were introduced, and that's the limited partners can only deduct up to that at-risk rules. So I will not be showing you the calculation itself. I will leave it for our client.
Perfect. That's a good
And
idea.
I'll pass it to our Zero to continue.
Thank you, Priya. I'm going to talk about the transfer into a partnership. There are two options with no rollover and rollover provision. No rollover provision is simple. Partner's disposition is at fair market value. Partnership acquires at fair market value. For the transfer with rollover provision, however, first of all, it has to be into a Canadian partnership, and for the property may be transferred on the rollover basis if all the members of the partnership they jointly elect the amount, which is usually the tax amount. So in that case, the property can be transferred on the elected amount, again, tax amount. But this applies whether if the client is a new partner for the partnership or is an existing partner in the partnership.
And it has to be unanimous, right?
Yeah, exactly. All the members, they have to elect on that.
Great.
However, if they choose to use the rollover provision, there are a few differences between the rollover provision under Income Tax Act 85, which is the rollover to a corporation, and the Income Tax Act 97, which is the rollover to a partnership. Number one, if it's a real property inventory such as land or building, the transfer can only be done into a partnership and not into a corporation. Number two, if the consideration received is less than the value of the property transferred to the corporation, then the difference results in a gift, and in case of partnership, this gift will be added back to the ACB of the partnership interest, which Priya went over, partnership interest. The third one is if the transfer receives a consideration higher than the value of the property transferred, then if it's a corporation, then the excess is subject to taxation. But if it's a transfer to a partnership, then the excess is generally a withdrawal from the partner's side, therefore it will not be subject to taxation. Now Anna will talk to you about transferring out of partnership.
Yeah, in general, the transfer out of partnership, the partner is considered to have an acquisition at fair market value, and the partnership is considered to have a disposition at fair market value. This rule applies when a partnership dissolved or one of the partners wants out. When transfer from partnership to another partnership, rollover rules applies right away. The new partnership is considered to be the same entity as the old partnership, which means there's no tax consequences for them. But all of the properties of the old partnership has to be transferred out. When transfer from partnership to a sole ownership, the rollover rule will apply. If one person of the two-person partnership retires or dies, the other partner carries on the business alone. The rollover rule will be applied within 3 months of the end of the partnership. However, if the tax cost is greater than the ACB of the original partnership interest, there will be a capital gain. If the tax cost is smaller than the ACB of the original partnership interest, the cost of non-depreciable assets could be increased to reflect the difference. Since rollover rule is only applied to the partner who continues the business, the retired partner will follow the general rule and consider to a disposition at fair market value. For transfer from partnership to corporation, transfer of assets and transfer of shares has to be considered separately. For transfer of assets, joint election is required for all the partners. The elected value can be at cost, so there won't be any tax consequence. For transfer of shares, rollover rule apply automatically. The corporation transferred in has to be a Canadian taxable corporation, and the partnership has to be wound up within 6 days of the transfer. There are exceptions to tax-free provision if transfer of non-eligible properties, such as the inventory of real estate that Rizal just mentioned. The transfer will be at fair market value with normal tax consequences. If the partner will receive more than ACV of the original partnership interest, a capital gain will be created. That will be.
Great, so thank you for all your input, and we'll present this collectively to the client next week, and I think all will go well. Perfect, have a great day.